Today, I wanted to welcome to the podcast with us is the accomplished Param Singh. Beginning in 1999 in the life sciences sector, Param quickly rose to the prominence as a senior executive at a global management consulting firm. Today, as the managing partner at Spur Equity, he is relentless in his pursuit of top-tier real estate investment opportunities. His experience in financial modeling and risk management, combined with his deep understanding of market dynamics, makes him a trusted name in the investment world. Dedicated to bespoke hands-on service, Param is known for crafting solutions that cater to both investors and stakeholders. So without further ado, let me bring him on and we'll jump right into it. Hey, Param, how are you?
Good, Mark. How are you doing?
Excellent. Did you get an opportunity to go down to New Orleans for the last race retreat?
We didn't get a chance to do that we really wanted to, but just, life and work, and it's just nonstop, right? So we really just couldn't take the time out to do that this time. But it looks like we missed a good event.
Yeah, I missed it as well, even though my sister's in New Orleans. So I really had two reasons to go down. Matt just was down at BPCon, so I'm a little jealous of that. But yesterday I did book my hotel for the next Race Fest in February. So definitely looking forward to that one.
Yeah, same here. Matt, awesome. How was BPCon? We actually had Yona Weiss on our show just a week or two ago. So he was headed down there. So he shows up everywhere. But how was BPCon? We were thinking about that one too. But
it was great. Mark asked me if I went to Universal Studios afterwards, and I was like, I have a 6-week-old second child right now, and so it was enough for me in terms of spending enough relationship capital to go there with a 6-week-old, my wife. So to be in Orlando in that close of proximity to Disney World, and then, oh, honey, I have to stay an extra night to go to Universal Studios without you. I couldn't quite play that, but I did see Yona. I did see Yona there. I said hi to him, thinking that he would recognize me, not realizing that he does about 400 podcasts a year. And so we got to chat a little bit. He was one of the keynote speakers there, talking about cost seg, of course. But no, it was a great experience. There was like 2,600 people that were there at the conference. I think that, I guess, speaking of conferences, right? A lot of people are misguided and thinking they're going to go to a conference and then get like some, just nugget of information that they've been missing this entire time. That is like the key to unlocking, whatever amount of gates they go to. Sure. The objective of going to a conference is to build new relationships outside of your sphere. Yeah. So that being said, the reason I went there was two objectives. One was to, a lot of people that were speakers there were guests on my or our show, because I run a show that, we record every Wednesdays at noon, just to be able to get belly to belly with those people that were guests on my show to sort of further that relationship. Yeah. And then just make a few extra friends in the process, which I felt I was successful in that, and I was able to, give some value to some people that were sort of, midstream in their investing career. I've been in real estate for 17 years. So that gave me a good opportunity to do that and try to put the ladder down for some other people. But no, it was fun. I thought I was going to sleep like a baby, but my body was still so used to PTSD with waking up every 2 hours with an infant that I kept waking up every 2 hours because I was like, but there was no screaming baby.
Awesome.
Yeah, no, I really like, I think you said it well. I think the networking component of the conference, of any conference that we go to, right, is huge. I personally still, like, no matter how, we've been doing real estate for a number of years now. And so, going to all these conferences and, a lot of people say, there's no magic to it, right? It's really kind of, finding your passion or finding the things that you're interested in. But like, as far as like putting deals together and kind of running, there's no real magic to it. But I will say that, no matter how many conferences I go to, there is always something, right? Something new that you learn, a new way of thinking about something. And, our industry is a changing industry, right? Real estate as a whole is changes so dynamically. And even this year, right, how much change has happened. So people do have to figure out new ways of doing things. You can't just kind of regurgitate what you've done, and what has worked may not work in the future. And so I think that these conferences really allow us to reinvent, right, how we're going after deals, and what how to do things differently, how to change that dynamic, how to do it better, right? Because the way that you're doing it, it may have worked, but there's always ways to improve on that. So that component is there, but certainly networking and the partnerships that we've had that allowed us to grow have all come through these conferences and these masterminds, where again, there's people out there that are doing things a lot differently or better, and it just kind of, it has to click, and you get to know who these people are, right? Because values have to align, right? Projects come and go, and there's always going to be projects and deals, but how often do we find people that we really resonate with, and we want to work with together? So we value those partnerships, and these conferences are where we solidify those relationships. So
Param, I want to pull on a thread a little bit that you said it, and it's a great way to start the show. Actually, is things are rapidly changing in the real estate space. Elaborate on that for us, please.
Well, so when we started this, so I'll give you a little bit of background on our journey. Like we, individually, me and my brother, Rap, who's my partner now, we individually, did our thing. We were, W-2. He was working on a brokerage. He started in like graphic design, and then he started doing real estate brokerage on the side. I was IT, corporate, in the life sciences sector, really dealing with clinical trials and those things. For over 20 years. But, my wife and I both consulting, we had disposable income. So we're like, hey, we need to invest in real estate. So what's the first thing that anybody does when they have a little bit of disposable income is, hey, let me go buy a house, right? Let me go buy a rental. And so that's what we did. We did short-term rentals. We did long-term, kind of single family. That's where we started our journey. And then, 5-6 years ago, again, my brother and I were seeing that we're doing all these things kind of individually. But, we were like, hey, why don't we do something together and actually figure out what that right thing is? And so we have a saying in the Punjabi community that 1 and 1 is not necessarily 2. It can be 11, right? So what you can do together is actually greater than the sum of you two put together. So we took that, mentality and said, look, let's do something together. And so we sold off all of our assets, and we're like, hey, let's go jump in. And we looked at, the market sector, and from the real estate standpoint, people are doing retail, people are doing hospitality. He was a retail and hospitality broker at the time. So my natural instinct was like, hey, should we jump into hotels? And he's like, no, we don't want to go to hotels. Because he's like, I work with these guys day in and day out, and it's not easy. Like, you have to know the operations. You got to know that business to really do it. And so we can't do that if we continue to have our W-2 job at the time, right? And so he's like, we got to add something that is largely passive, recession resistant, right? That even if we don't know what the heck we're doing, it's still going to make money for us. And so we went all in on multifamily. This is now back in like 2016, 2017. Great time to get into multifamily. And so we did it. We didn't know what we're doing. We're operating ourselves. We're managing ourselves. But we managed to make money, right? Like, we managed to appreciate the asset. We managed to raise rents. We managed to improve it, like, small, mid-size assets. And so that was the aha moment. Like, hey, multifamily, like, I have predictability into where this asset is going, where the value of this asset is going. And so even though we didn't know what we were doing, we knew the formula, we knew the basics. And so we started to educate ourselves a little more. How do we do this better? How do we do this more efficiently? And so you learn very quickly what your strengths are, what your weaknesses are. And so the first time we went into this, we're like, all right, we'll do everything, learn everything. And then we quickly found out, like, we don't like property management. We don't want to do property management. And so the next time we did it, we're like, all right, 1031, we made great money. We bought a bigger asset. We're like, we don't want property management. We're going to hire professional property management and run it that way. Again, a little bit more efficiency, working that into the plan, and then, just doing things better, one-off, right? And so what happened was then friends and family that saw what we were doing, right? My sisters, cousins, friends, they're like, hey, you're doing really good. You do, a couple of these deals and you're making good money and you're going and buying bigger and better things. Like, how do I participate? Like, I'm a business owner. I don't have time to find real estate. I know I should be doing that. I'm a lawyer. I'm a doctor. I have income, but I don't know. I know I should be investing in real estate, but I don't know how to do that. So how do I do that through you? And so that's where our syndication firm sort of started, really because people were coming to us with capital and said, hey, let's go do stuff. And so we had to educate ourselves again to say, okay, how do we do syndications? How do we do it the right way? Using your own money is one thing, but when you have other people's money that you're a fiduciary to, it's a whole different animal. And so we really had to do it the right way. So, hiring the best syndication lawyers, making sure that, all the legal stuff is figured out. But then, we had a much broader reach as to what we could purchase, right? And so that really snowballed, from one project to another, to another, to another. And it was through these conferences, like I said, it's through partnerships that we were able to do that and bring our investors along for the ride. Now, that was multifamily. So back to your question about, what's changing in the industry. Well, we were all in on multifamily in 2018, 2019, through the pandemic. Obviously, everybody was doing really, really well. But as soon as lending started to change, right? As soon as to change and the interest rates started to go up, and cap rates at the beginning of that weren't really budging a little bit. So we saw folks that were overpaying for assets that were out there. So we were underwriting deals. We were trying to we're putting in LOIs. We're still acquiring some properties, but for the most part, a lot of that underwriting, a lot of the price points didn't make sense with the new, where we knew lending was going, right? And so we had to pivot. And so our investors were hearing what's happening in the multifamily space. A lot of deals were struggling, right, to make expenses, because not only we kind of hit the trifecta. A lot of people hit a trifecta where, okay, interest rates went up. They were, some people had adjustable rate mortgages, so obviously their mortgage skyrocketed. Nobody could have predicted that, right? We underwrite for, let's say, a certain percentage plus or minus, right, of where that's going to go, but nobody could have predicted it was going to go double and then some. But at the same time, year over year, our property taxes were going up, right? Inflation hits. Utilities were going up. Inflation hits on the operations, and insurance. And so all of these things were happening all at the same time. So you find this struggle in operations that now all multifamily deals are not making sense, right? And so what we had to do was pivot and say, okay, what other assets are out there that have a slightly different risk profile that still allow us to make money? And gone are the days of 20 to 25% annualized returns, right? Those are days of the past potentially, but but we're still wanting to invest. How do we do that? And so we had to pivot with the industry changing to say, okay, what other asset classes are out there to manage that risk? So we went into self-storage, which is congruent to multifamily, same sort of drivers, right? But we also went into industrial. Industrial was a nice pivot for us because it allowed us to give a very, very predictable outcome to our investors, right? Because we're talking about, we don't care about operations, because right now everything, from a multifamily perspective, where that needle is moving is on the operational side, right? So people that are really, really good operators that can squeeze every penny out of operations are still doing well, are still kind of riding and going to weather the storm. But we wanted to take that risk out of it, and so we went into industrial, absolute triple net properties where, hey, all we care about is income. So we have fixed rate mortgage, we have the rent from a corporate backed guarantee, which is a 20-year lease. So we don't even have to find, tenants every year. It's a 15-20-year lease, and with 2-3% modest increments in rent over the, every year. And so we have this predictable curve of exactly what we're going to make from income, exactly what's going out the door with a fixed rate mortgage. And so there's no outside inflationary pressure on us, because property tax, insurance, utilities, all of those are going to be paid by our tenant. So that was a very nice pivot for us to say, okay, hey, I know you're looking for predictability. And so rather than going into the money market accounts that are offering the 4 to 5%, here's something that's going to get you into the teens, right? Very, very predictable. And so those are some of the things that we did to diversify in a changing climate. We're still bullish on multifamily, so don't get me wrong, right? We still like multifamily, but we went to our investors and say, hey, what do you want, right? And so if an investor has $1 to invest with us, and out of that dollar, they allocated 40% towards multifamily. Well, I want to provide them an opportunity to invest the 60 cents that they have left over. I don't want them to have to go to other places. And so for Spur Equity, we're like listening to our investors, finding out what their risk profiles are, what kind of assets they're looking at. And that's what we're trying to find in terms of these partnerships, to be able to provide those opportunities.
Yeah. I would imagine that the industrial is a little undervalued compared to the multifamily residential, just because of what we've seen in the market and what we're seeing now. Would you agree with that statement, or?
Yeah, I think so. I mean, cap rates are different, right? In those in that asset class, and then different. We're looking at different geographies. It's a fund, so we looked at all over, all over the continental U.S., where, because of the pandemic and supply chain issues, there's a big resurgence of kind of manufacturing and storage and all that stuff in the contiguous U.S. And so where we saw that resurgence, that's where we saw those opportunities. And again, we're not, in that fund, we're still being selective. We're being very, very selective as to what type of asset we're looking at. So we're not going after, companies that are struggling necessarily, right? That are looking to kind of sell off their assets and just to put an injection of capital into a struggling business. No, we're looking at businesses that are thriving, that want to grow to the next level. And so what they're doing is they're selling off their real estate, but they have invested so much in that real estate that they're leasing that back from us in a 15-20 year window. So we know that they're going to still be in that location, but they're injecting that capital back into their operation. So they're expanding their operation, they're growing their operation, and that's why they're selling off that asset. And so that gives us a lot of confidence and comfort that this lease is going to be, it's a corporate backed lease, but they're not going belly up, right? They're really thriving businesses that are going to honor that lease, that 15 to 20 year lease. The other thing that we looked at from an industrial standpoint is we don't want anything very, very heavily specialized. Think about like power plants and smokestacks and things like that, like very heavy manufacturing, because, again, we're hedging our bets, right? If there's a risk for that tenant, if they do, go belly up, or we have to find another tenant, it's got to be very specialized then to fill that asset. So if we talk about light manufacturing, storage, refrigeration, things like that, that's very easily swappable. So if in fact they do, that we do have to find a tenant, it's going to be easy for us to swap that out. So those are the kinds of, considerations that go into kind of acquisitions and kind of building a portfolio of industrial assets that we're looking at from this fund perspective.
Yeah. So I know in multifamily, there's a lot of repositioning happening, especially with like these office buildings that have been in decline. On the industrial side, are you seeing that there are opportunities for like a build to rent type scenario where there's so much influx that there's a need for new space?
So not necessarily. Well, again, we're not looking at it from that lens, right? So we're looking at it from, we want it to go to, again, established businesses that are growing their footprint or growing their operations. And so The key thing, I think if you talk about, again, this is a very, very predictable model, but there's still opportunity for value add. There's these value add opportunities that are baked into and what we're seeing is companies where, again, they have this real estate asset where, they've already built out operations, but there's land that's part of that asset. And so we've already spoken to a couple of them where they're like, hey, we want to build another building. Great. That's going to be the tenant that's actually now improving this property, which we own, right? Because that's what's dictated by their operations and what their need is. But as they're doing improvements, that's increasing the value of the asset that we own. So those are the value add opportunities that we're seeing, where they're doing heavy rehab or heavy CapEx again, on from their expenses, but they're improving the asset that we own. So those are again really, really nice add-ons from our investor standpoint, because we're looking to, while we have 15-20 year leases, we're looking to exit within a 5-6 year window. And so we're going to appreciate this asset, and if the tenants themselves are improving the asset, we're not spending CapEx. But we also have another opportunity where we can manage that from a property management perspective. So we can manage that CapEx, we can manage that construction, and still make a little bit more revenue for the overall business on our side. So those are some key sort of add-on opportunities that we're seeing on the industrial space. But Mark, I would say that what you're saying is 100% valid. That kind of like the BTR repositioning of industrial assets as well. But we haven't necessarily looked at it from that lens necessarily.
So Param, we had a question in from LinkedIn from Hussein Tayebi. He said, I don't know if you can answer this, but what is the average return to investors that investors are accepting at present?
It's all tied to, for us, right, our investor sort of avatar. We have a couple of different avatars that we look at, a couple of different investor personas, as it were. We have, and it's all tied to their risk tolerance at the moment, right? So we have a bunch of investors that are high net worth, returns. They don't need cash flow, right? So we're looking at assets that may not have very, very high cash flow because that's not the need, but they're looking for an overall average return of higher than 15%, right? Let's just say, 15 to 20% annualized is what they're looking at in today's market. And again, they don't necessarily care about the cash flow component because that's not where wealth is created anyway. It's really on the exit. So they're looking at, riding the storm out, right? Parking their money somewhere to ride the storm and kind of make that 15-20% return. And then, exiting to be able to deploy, in other assets. The other thing that same kind of investor persona is looking at is the depreciation factor, right? So any kind of tax savings that they can do by deploying and purchasing assets, that investor is looking at that too. So, while you're making a 15-20% return, you're taking a depreciation on year one because it's an existing asset. So we're doing cost segregation on all of our industrial assets, for example. And so they're getting a tax savings every year from that perspective. So overall, they're netting out quite positively. But I would say that again, during the pandemic, everyone was kind of echoing or 20-25% annualized returns and even more, right? I think our investors are very savvy and understand the current environment and current risk, and so they're willing to kind of adjust their risk according to the return. So lower risk, lower return, that's totally fine as long as there's predictability in there, because a projection is a projection, right? So anybody can say, hey, we're going to 2x your money in 3 years, but is that baked in today's reality, right? That's really what we have to see, because we're seeing, cap rates, change day by day. And so if your cap rates are, in line with interest rates, right? And so we have to bake our projections in reality, and the reality is the interest rates aren't coming down anytime soon, right? So we have to model for that, and so that's kind of what we're looking at, from our perspective.
Yeah, a follow-up question from Hussein is hold period. I think you highlighted this a little bit, 5 to 6 years for a hold period.
Yeah, for the and it varies on the different assets that we're looking at. So I'll mention another thing that we're doing from a diversity perspective, but the industrial assets, we are looking at a 5-6 year hold. Again, we're going to start to look at exits right around that 4-year mark. And our exit, looking at either selling off individual assets, or even, a portfolio of assets, to an institution. So institutional buyers is who we're looking at, because that's who likes these kind of, predictable model, right? Lower risk, and kind of ride that out. And so we're looking at REITs and other things that will purchase these long-term leases that we have on the industrial side. So the hold period on that, again, is that 5 to 6 year window, but we'll start looking at exits around year 4. The other thing that we did recently was look at, and it's kind of, it's different because it's not multifamily, but we're looking at land development. So we looked at land. We did a very kind of small case study, as it were, for land development in a affluent area in North Carolina for single family homes, but single family homes that are like estate homes. So again, we're talking about, $1, $2, $3 million homes in the most desirable school district, for families, affluent families in North Carolina, in Charlotte, in the Charlotte MSA. Again, not folks that are too. It's not something that's going to be correlated from a market perspective, right? That's going to have much impact. So, and it was a small enough deal where we took this plot of land, bought it, entitled it, rezoned it to, it was a single plot of land, and we zoned it to 23 lots, right? So 20 homes, and we're going to sell it to end users or sell it to a builder, because we're not interested in actually building those homes. We're just rezoning. So it's a very quick in and out. It's a 12 to 18 month window. In entitling and rezoning and permitting and all of that. And then we're also doing development. So we're building a road through the property. So, and the utilities, and bringing utilities to the lots. But after that, we're done. Right. And so we start to sell these assets right after the permitting stage. We can, as soon as the plat map is done, we start to, and we're already starting to sell it. And so we partnered with a builder to do that. But we're selling them one off, and so to maximize that return. So again, it was an answer to, again, all of the saturation that we had in multifamily. We're trying to sidestep that and provide an opportunity for investors to look at a different asset class. And again, it's a shorter runway, so people like that, but also no cash flow again, right? But you're looking at a pretty low risk. Because there's not a whole lot of, risk that other than, permitting and all that stuff, like whether that's going to happen or not. But we don't, we have relationships in those municipalities where we're doing this type of stuff, where we have confidence that we're going to be able to entitle, rezone, and all that. And so ultimately sell the assets individually. So that was another area that we looked at. And I think we're going to do more of that opportunistically, but it's going to be part of our investment strategy to, again, allow and bring those types of opportunities that are not necessarily 5-6 year holds. They're, 18 to 20 months, 24 months, maybe even shorter than that. And you get to see a decent return on that. Right. So again, same thing around, 20-25% return annualized on a land dev deal is, in a 12 to 18 month or 24 month window is pretty lucrative as well.
Yeah. You can't beat that, really. Are you worried about, recession type influences on those type of deals?
Not that one specifically, just because we're talking about 20 lots, right? And so we've already had a lot of interest even before we, went out to market. We had a lot of interest in sort of pre-sales, and so people kind of looking in that area for those lots. And I don't know the numbers right now, but I would venture to guess that a number of those are already under contract. And so we're not too worried about that one, just because if it was 200 lots, I'd say, okay, yeah, it's going to be an uphill climb to try to get to where we need to go. But I envision us by sometime mid next year to be completely sold out of those. So that's going to be our our window that we look at for that one.
And you just leave it to the builder to take care of all that as far as the marketing.
Yeah. So it worked out really well for us. I mean, we budgeted in our underwriting, marketing dollars, right? And hiring companies to do all the marketing and the launch. And, it's got to be, because they're like, these are estate homes, you have to spend a pretty penny on marketing and make it nice and all that stuff. So we partner with a builder and truly in the spirit of partnership, right? These guys are leading the marketing, right? And so they're doing that on their behalf because they stand to make a lot more money on the build of that home. And so they're coming to the table with a marketing plan and really doing, I think next month we're doing like this on-site launch where they're gonna bring their team and golf carts and stuff like that and take people out to the sites. And so it was truly in the spirit of partnership. So that marketing budget is really on the builder. And so again, it's incentivized partnership, so they get to sell and move up. And then on our side, we got to really reduce what our budget is on the marketing side. So that's going to help our bottom line and our investors' bottom line.
Do you help them with their marketing? Was that kind of like the play, or they have their own marketing, you have your own marketing? And then a follow-up question, did they go and put a model on that site so they would have something that they could bring potential prospects to look at?
Yeah, so that hasn't started yet, but yeah, that's the plan, to do some sort of spec. And if you go out on like Realtor and Zillow and things like that, they've already put specs on specific lots, like the plans. And so obviously, the earlier the buyer comes in, the more customizations and things like that they would get to make. But they're looking at each lot and looking at what house footprint actually fits that particular terrain. So they're doing it really, really systematically from that perspective, given their experience. So it's really them leading the marketing and with our assistance, right? And so we're helping that engine, but it's really their marketing team and taking live, like they're the ones that are in charge of all the listings and everything.
Yeah, I was just curious because I know that some builders will actually have investors finance the models and then they'll lease them back from the investors. I didn't know if that was something that you were thinking about working into your land dev model, where you do this and then you convince the builder that, hey, you should buy a lot and put up a house and we'll finance it for you as part of the deal.
Yeah, I mean, so we didn't go that route just because we wanted to make sure that our runway is as short as possible. And so we didn't want to wait for a model to be up and constructed to be able to sell these lots, nor do we think that that's going to be necessary to sell the lots individually. But the partnership with a partner allowed us to get creative, where there's plenty of builders that would want to be in that specific location, but we, wanted to offer an exclusivity clause to this builder. And so something that's aligned with that exclusivity clause is that incentivizing them to actually sell X number of lots per month, right? And so they have to kind of do that over the next few months to be able to hold us to that exclusivity clause. Otherwise, we can bring in other builders to then, sell the remainder of the lots. So, there's things that we can do to get creative to kind of push, push the timeline. And again, we want to be out to be able to exit. And so we don't want to dictate necessarily what the builder does in how they roll it out, as long as they, get the lots sold themselves.
Right. Yeah.
So I had a question kind of going back to the industrial side of things, because you said something interesting there. Target hold period is about 4 years. My assumption is that 4 years, because you want to have for it to be attractive to an institutional buyer that may give you a more favorable cap rate than a retail investor, for instance.
Right.
Am I correct in that assumption?
That's right. Yeah. So all of our acquisitions should be done, within the calendar year or within the 12-month period of the fund. And, then we start to see kind of, build out our pro forma, when all the assets are under the fund, and then we have the 2-3% increments. So we want to be able to ride that. And then at year 4, start looking at exit. So what the exit strategy we're looking at is, again, either individual sales or looking at it as a holistic portfolio at that point. But you're absolutely right. Like, we want to be able to have enough runway left on the leases so that it's attractive from a purchase standpoint. Yeah, we don't want to run that. But again, given that our industry is dynamic and changing, that we do have our lending, for example, we have in some cases 7, 8, 10 years, kind of debt kind of figured out, so that if we need to ride into year 7 because of what's happening at year 5 and year 6, we have that flexibility. So we're not going to be, in any case, we're not going to be a forced seller. Right. And so we've hedged against that. And again, all the increments are still there. So we're still going to be making good cash flow or good returns on it. And so we're not going to be in a position where we're a forced seller, but we are going to start to look at exits, starting at year 4.
Smart. So on the acquisition side of those industrial deals, is your avatar looking for is it a sale leaseback type of arrangement typically then?
Yeah. Yeah. So majority of what we're looking at from an asset acquisition side is going to be sale leaseback. So again, our partner on this fund has a whole acquisitions team, and the criteria and it's kind of the what their the tenant's kind of bank statement looks like, what their financial and credit history, all that stuff, right? From a strength of the actual of the tenant. And we are not looking at tenants that are single location, right? It has to be corporate get back guarantee. So there's if they have locations all over the country and we're targeting one of those assets, if that one goes under, we're still going to get that rent, right? So those are the types of things that we're looking at. And we're also diversifying even within that, so that we're, again, if a tenant has 6 locations or 10 locations, we don't want to pick up 3 of them, right? We're only looking at 1, and then we're going to diversify with a different tenant, a different corporation. And so, that's what we're looking at we don't want to put a lot of our eggs in one basket, right? So we are kind of diversifying from that perspective as well.
Awesome. One last question, Mark, on the industrial thing here. So from a deal sourcing standpoint, I know you have a partner that's helping you on the deal sourcing to look at opportunities. How does one go after sale leaseback opportunities from a marketing and visibility standpoint?
Yeah, that's a great question. So I'm probably not the right person to ask that question, right? Because I said, we don't have visibility necessarily, too much visibility into, the boots on the ground that are actually chasing these opportunities. We know exactly the criteria. Once something comes to the table, we know exactly what to look for, right? To say all right, this is the type of tenant, this is the credit, this is the financial score, this is the, in that area that the asset is in. What are the drivers for that particular, industry that they're operating in? So, we know that from that perspective, but it's really the acquisitions team. We have a great acquisitions and sales team that's going to actually find the opportunities. But And we have a robust pipeline right now that, we're working through. So we've already acquired, I think, 8 or 9 assets. So we only have a few more to go, and a couple of them are already under contract. So we're at the tail end of what we're doing for this fund. I would envision that this same fund will actually repeat it next year. So this is the 2023 fund. This is actually fund 2 for this partner. And so there will likely be a fund 3, given the performance of fund 1 and fund 2. But I'm not too close to how they find these opportunities, because you're right. It's not something that's out there, right? That somebody's marketing or it's really relationship driven and approaching, these types of companies that are looking to inject capital back into their operations, right? Thriving companies that are looking to do a creative injection of capital. And so this sale leaseback opportunity allows them to do that.
All right, Mark, I wanted to stop monopolizing on the industrial.
That was good. Those are all good. Yeah, my father's got some industrial space down in central Pennsylvania, and he's getting towards the end of his career, and so he's starting to think about maybe selling it to somebody. And he's one of these old school operators that without him there really is no business. He takes a lot of the phone calls, and so for him to market it and sell it, it's been difficult. It's pretty much just like a conglomerate of all of the pieces is all he's asking for. Somebody could walk in and pretty much buy it for the cost of the assets, which I think is just totally insane. So I've been, really stewing on whether or not that particular property is something that I should push him towards, keeping in a portfolio and getting leased out to somebody else. I mean, he already has some subtenants, which pretty much float the building already. So it kind of seems to me it's like a no-brainer.
Yeah, and I think we talked about this, Mark, right? Like, the other piece of that when you have an asset like that is the emotional component, right? Because it also gives is it your father or your father-in-law?
My father. Yeah.
Your father. I think we talked about this. It gives him an opportunity to go out to, and do something and retaining that asset and leasing it out or whatever, it still allows him to do that, right? So there's that emotional component as well that's got to get factored in. I try to not to be emotional when it comes to assets, but in cases like those, you have to take those into consideration, right?
Right. And he's got a nice little office that's kind of segregated from the main space. And so I'm telling him, you could just keep that office, lease out the rest of the space, and then you already have 3 other subtenants that are paying you pretty healthy cash flow.
Right.
And he's like, I don't know, I just want to sell it. And I'm like, well, are you adding in the cash flow that you're receiving to the sale? He's like, no, they can just have it. So like basically whoever buys it inherits 3 tenants. And it's pretty strategically located industrial wise. There's not a ton of industrial space where he's at, and he's got a really prime piece that's on the rail, and he's developed the rail as well. So he's spent, a couple $100,000 stabilizing the land and being able to bring heavy equipment in to do some transloading off the rail. So I feel like it's a shame that, he's focused so much energy, building this company. And now at the end, it's kind of like, what's he going to do?
Yeah. The reason why I asked about the deal sourcing side of things is because we've gone after sale leaseback opportunities because we're opportunistic investors. So we're like you, Param. We look at the market, look at where there's inefficiencies in the market, and see if we can capitalize on those market inefficiencies in the real estate space. And so we had talked to some people that we did marketing to that were business owners of some pretty successful companies, intrigued about the sale leaseback option. A lot of these people owned their building free and clear. And so, we made them an offer, and in the offer included the terms of a potential lease arrangement. And like, well, we're only paying property taxes, on this building and have for the past 10 years. And you're talking about, tripling our, monthly expense associated with paying you guys rent. That, like, how does it make any sense for us? So we've always had a, hard time threading that needle with potential, property owners who've been looking to do a sale leaseback. So, but it's definitely something that, we're open to doing in the future, but we haven't had much luck in terms of sourcing those types of deals.
Yeah, and different sectors will have a different model for that. I'll give you an example. Like, I wish we had moved forward with this, but we were actively looking right before the pandemic. We were actively looking at home builders in Texas that were building model homes in like, every community, right? Like there's one that was building, model homes, and then the homes in like 9 or 10 or 12 different neighborhoods in the Houston metro. And so we approached them and said, "Hey, we've got these models. We'll buy them, and this neighborhood is going to be here for the next 3 years before you finish it." And so, a sale leaseback. So we were like, we'll purchase all 12 of your models, and so that gives you that cash injection. It gives you cash right up front, and then you lease it. They lease it back. And so a lot of builders have like sale leaseback programs like this. I don't know if they have them anymore, or you can approach them, but like sometimes the numbers don't make sense. But if you think about it, and we also passed on the opportunity because again, we couldn't figure out the right negotiation at the time. But had we purchased those, and the amount of appreciation that single family homes have done in the last 3 years, like we would have been sitting on gold. Like it would be amazing. Who cares what the leaseback was? Like we own those free and clear, and not free and clear, but we would have owned those, and then we could have sold them to an end user, sort of at the tail end of that lease. But yeah, it was, hindsight, right? But yeah, there are different sectors that do already have like a sale leaseback component, this absolute triple net component built in. I mean, think about like, we see it on LoopNet all the time, like a Starbucks building, right? Starbucks is going to be there for the next 50 years, right? It's not going under. And so you can buy a Starbucks that has, like a retail center that has a Starbucks and maybe like an AT&T center or whatever. And yeah, the returns aren't great, but they're predictable, right? It's an absolute triple net. You can park your money there. You can get, now obviously lending changes the dynamic a little bit. So you got to make sure that, you're going to be made whole, at least, with your mortgage and stuff. But absolute triple net does make sense in some cases. We know guys that are running funds that are buying Dollar Trees all over the country, right? With the syndication, they're running a fund and they're literally going after Dollar Tree locations that are absolute triple net. They have 10, 20-year leases on them, but they recognize that this is a low risk fund. So the returns aren't going to be spectacular, but it's predictable. And so a lot of folks want to, however we say, for our investors to diversify your stock portfolio, diversify your real estate portfolio, and make sure that you have adequate, kind of risk assets, kind of identified, right? High risk, medium risk, low risk, like, mix it up. Don't put everything in a high risk situation. And so those are definitely great, assets to go after. And then, again, depending on your personal tax situation, from the depreciation you get from those, if you're doing a cost seg and everything on existing assets, that might actually be something very advantageous, right? With the depreciation that you'll get from those assets in year one. So, I say that, with real estate, it's always a good time to buy real estate, right? People are sitting on the sidelines right now, and kind of waiting, right? There's a lot of capital just kind of sitting on the side and not doing anything. And there's obviously less transactions that are happening, but I say that there's always opportunity. You got to get creative. And this is why, networking and listening to other people really comes in handy, because you'll find an opportunity that you would never even think of, like, oh, that makes sense, right? And so I think there's always opportunity, and even more so, like, think about during the pandemic, there were so many, you guys know, like there were so many deals, and you had to like figure out like and underwrite so many things to make something make sense. Now there's less transactions happening, so there's less deals out there to sift through and find like the gem. It was harder to find the gem, when there's so many things going to happen. But now, there's less transactions happening, so there's less things to sift through. But there's always opportunity, right? There's always opportunity. You just have to and learn the lessons that we learned in the last couple of years, where there were people that made money which had no skill set, right, in operating. They literally just rode the appreciation curve. And so now whoever's actually coming out the other end is going to be people that really, really know their operations, or really, right size their deal, right, to protect investor capital. And so learning those lessons, making sure that your future deals are protected from all of that. And again, like I said, we hit the trifecta. We had inflationary pressures, everything going up more than what you projected, right? Insurance, taxes, utilities, and then, obviously lending. So we still have to figure out what lending's going to look like next year. But again, if you model fixed debt, or if you get creative with PFCs, HFCs, right, to kind of reduce your expenses, then you can ride sort of positive appreciation from that perspective, right? So I always say that there's always opportunity, and that's what we're looking at. We're looking at we've done, this is 2023. We did, I think, 7 or 8 deals last year. This year we've already done 2. We're going to do a 3rd one. So yeah, deal flow is slower and there's less there, but there's always opportunity. So we found, 3 good deals that we're very positive about. And so we're still moving forward with those, and investors are with us, those that understand that, hey, there's still money to be made, right?
Yeah. What are some secrets for finding the best deals? Do you feel like networking, like masterminds, brokers, or is it what you're doing internally as far as your operations that are really scaring up these excellent opportunities?
It is networking. So the couple things that we had to do this year was really listen to our investors, right? Understand what they're feeling, understand the reservations that they have in terms of investing, right? Because we might think we know, but we don't know the whole story of just what investors are feeling. And that plays 2 things. One, you get to hear what they're looking for, so you can find those opportunities. But second, it gives you an opportunity to dispel any sort of myths that they're listening to, right? Any sort of misinformation that they're listening to, because again, people are like, we want to stay away from multifamily. Like that's not necessarily the case. Like we don't need to stay away from multifamily. Multifamily is always going to be a great asset, but we have to make sure that we're looking at underwriting that's appropriate with reality, that's in line with reality. And a lot of underwriting that comes to the table, they're still promising a 2-3x return. It's like, let's dive in. Like where can you look to kind of look at what reality looks like. So that plays in it. But finding the deal flow, it's all about networking with partners. We ourselves, we have a relationship with investors. So I feel like we're capital raisers for the most part. Yes, we do have our own deals. We asset manage and property manage and manage our own deals as well, and do all the acquisitions and everything. But we find a lot of great opportunity because, again, you understand what your strengths are, what your weaknesses are, and I don't know everything, right? I'm not an expert at everything, and so when you find experts that we have an expert that deals in land development in a particular geography. So when he brings us a deal, we know it's solid, right? Because he's the expert in that particular thing. And so, the partners that we partner with in different geographies, we have stuff in Phoenix, we have stuff in North Carolina and other areas, but we partner with the best. So we partner with folks that have a very, very deep understanding in what they do. and their ability to execute, and they have a great track record. So I'm not going to be as great as them. So if I want to compete with them, it's just not going to work. So I have to partner with somebody that is that deep, so that I can be rest assured that my investors' capital is in good hands. Right. And so, yes, I'm still a sponsor in the deal, and I still have a seat at the table when it comes to decision making and deploying that capital and all that stuff. But I need to know that I'm sitting next to somebody that's way smarter than me in that particular, sub market or asset class, that we're investing in, right? And I need to believe in it, but there's got to be some expertise behind that for us to bring ourselves to the table.
So it's getting close to the top of the hour here. I want to get this question in. Roles and responsibilities. You and your brother are principals within your company. How did you carve out those roles and responsibilities from the beginning? And have they changed since you guys started with each other?
Yeah, so we complement each other. So the reason that this partnership works, working with family is a very, dangerous ground, I think, right? But sometimes it works, sometimes it doesn't. But we're passionate about real estate. We're passionate about a lot of the same stuff, but we're also very different personalities in that, his skill set and my skill set really do complement each other. So from an operations standpoint, I come from an IT background. So, putting together, the operations of our business and kind of, underwriting the spreadsheets, the financials, so I kind of run with that, right? He's a broker on the real estate side. He's been that for 15 years, now probably 18 years, in retail and hospitality in all of Texas and actually beyond Texas now. So from a real estate knowledge and, underwriting and kind of that network that he has to bring expert relationships to the table for insurance, for lending, for, all of that, and so we definitely bring different things to the table, and those kind of roles have naturally, kind of come together to really form the strength of what Spur Equity is. The other thing is I say this all the time, I'm a very analytical person. So I need a lot of information to be all right, just all these things align for us to move forward. He's a very gut check, let's do it. We'll figure it out. I feel strongly enough in this. Yeah, we don't have all the answers figured out, but I know that we can be successful in XYZ. And so that's how we got started. We jumped into, managing an apartment building, just me and him with our money, because he was like, let's do it. And I was like, are you sure? And he's like, let's jump in. We'll mess up. He's like, no, we'll make mistakes. 100% we'll make mistakes, but I rather fail faster so that we can recover and learn. Because if we just sit down and learn, and that's all we do, and we don't put it to action, we're just going to be standing on the sidelines. So we have the saying on our in our business and on our podcasts and stuff, we say, he says, knowledge is power, but action is a superpower.
Yeah.
Right. So yes, educate yourself, network, meet people, all of that. But the only way that you're actually going to learn is if you dive in. So, for an investor, that means, if you want to be active in investing, well, the first thing that you should do is be a passive investor. Invest in something, invest in a syndication with Mark or Matt or Param, and say, hey, I'm going to invest $50,000 because now I'm following this business plan. I'm understanding what you're doing. I'm understanding what we're acquiring and how we're making that 50,000 and turning it into 100,000. Right. And so that's the best way you learn, is actually put some skin in the game, whether it's, your time or your money, and your effort into something. That's where you're going to learn. Yeah. You may lose, right? You may fall or you may fail, but I call it in our first deal, I call it, we stumbled along the way, but we failed forward because we still made money, right? We more than doubled our equity in the first deal that we did, and we made mistakes along the way. And so how great is that? You're making mistakes and you're still net ahead on it, right? And you learn so much that you can apply to your next deal. And so I think that's our That's our biggest thing is action, right? Apply the knowledge that you have into action. Otherwise, you're just going to be sitting on the sidelines.
Yeah, that's 100% correct. I always look at it as like benchmarks. I make moves, take action, set a benchmark, and then try to beat that benchmark. And, if I'm not beating it, I'm trying to figure out what went wrong, what were the differences between this and that. So, yeah. So we've hit the top of the hour, it looks like. Do you have any other final thoughts for the audience, or you want to give them a way to reach out so if they can get a hold of you?
Yeah, no, we have our podcast. So our company's name is Spur Equity. So you can find us on all the social media channels, Facebook, Instagram, LinkedIn, Spur Equity, and SpurEquity.com is our website. But our podcast is Spur Your Wealth. So we're from San Antonio. So we had to play a little homage to the San Antonio Spurs. So Spur Equity and Spur Your Wealth. So we're paying a little homage to the San Antonio Spurs and the great city that we live in.
Yeah, and then you'll be at the Raise Fest conference in February. Are you planning on any other?
Yeah, we'll be there.
Any other conferences?
We're looking at conferences right now, and definitely be at Raise Fest. We actually have 3 assets in our portfolio in Phoenix, so I'm glad that it's in Phoenix. So we get to check up on our assets. We're trying to grow our portfolio in Phoenix as well. We're really bullish on Phoenix. Love that market. Our assets are doing well there, and so. But we're always looking at conferences. We tried to make it out to BPCon, but again, we have to. I think the summer with family being home and all that. Now that we're back into kind of the routine of going back to school, I think that'll allow Rav and I to go to more conferences and travel and things like that. So hopefully to see you and some of your listeners out at conferences. And if you see us, the two. Me and Rav, we're easily recognizable. That's why Yona knows us everywhere we go because of the turbans. But if you see us, we're really approachable. Please come up to us. For your listeners, just come up and say hi and tell us that you saw us on this podcast.
Awesome. Well, thank you so much, Param.
Sweet, Param, and I have an idea for you in the green room. So
awesome.
Hang back a second.
All right. Yeah. Looking forward to it.
Yeah. Right. Thanks, everybody. And we will see you next Thursday.